The Hang Seng currently trading above the flat line, but the Taiwanese index has been a bit of an underperformer today.
We're close to making a deal with India. Others we met with and we don't think we're going to be able to make a deal, so we just send them a letter.
Support for the Nifty stands at the low of 25,331. Resistance on the Nifty stands at the high of 25,669.
The markets really are figuring out that we are in this process of restructuring.
Nothing very much, 25,444 on the Nifty. The Nifty Bank is just sort of settling down, but doesn't amount to very much, at least the open, 57,000, flattish open there.
Within the consumption space, the higher ticket discretionary goods, they've done far well.
Every aspect of the capital market activity will get a boost the moment that share certificate melts.
What we've been given to understand from our sources is that market regulator may consider linking options market leverage to cash market positions.
Donald Trump says they are close to a trade deal with India. Frankly, everything is up to Donald Trump now.
For the markets, Nifty has seen some recovery from the lows. Bank Nifty is the one which is supporting those gains that we are seeing. Midcaps under pressure, but there has been a recovery again. So recovery is the theme that we are tracking right now. We'll have to see whether that stays or not.
Well, that was the day so far. Hello and welcome to Closing Bell. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I am Reema Tendulkar, and with me are Surabhi and Nigel. Hi, guys.
Hi, guys. And yet another afternoon where the Nifty is finding it difficult to even move 20, 30 points. I mean, it's that kind of a session. It's just uncanny. It's a strange kind of a silence that has descended, at least at the index level. Midcaps are falling. So that's the situation that we're in right now.
I'm wondering, by the end of today, if we end somewhere around here, it would mean for the first two sessions of the week, the markets have not moved at all. Yesterday, the Nifty didn't even move 1 point, and as we speak, it's moved a point. The good news, though, is that today the Nifty Bank seems to be in good form. That's up close to under 150 points. And from the word go itself, that one's actually been outperforming. So not such a bad outcome. I think everyone's waiting for what President Trump's tariffs and tantrums are going to do next to global equity markets.
And Asia was higher today. So Kospi was up 1.8% as it closed out the trading session. Hang Seng up more than 1%. The Chinese markets up close to about 0.7%. But the Indian markets, like radio silence, even today, the trading session had a range of just about 70 points. Yesterday, it was 80 points. Today, even narrower. And this would be the 7th now consecutive day that, markets have been absolutely unchanged and unmoved, consolidating in a very, very tight band.
Yeah, I'm pretty sure that there's enough chatter there. Whether this kind of radio silence, I think Reema used an absolutely beautiful term, whether this kind of radio silence has anything to do with what's been ongoing with Jane Street, with such a large institution being told to wind up positions, whether it has anything to do with the market, perhaps looking at fresh F&O regulation that could be coming. Remember, our colleague Yash did a story on this. We'll actually have him back to explain exactly what that story is all about, where Yash's sources are telling him that the regulator could look at some sort of interlinkages between positions in the cash market and F&O positions just to regulate excess speculation. But more on that story as we go on. Right now, let's talk about the few movers and shakers, at least on the index. I mean, some names that we can spot for you. Titan has been down right from the morning. This 18% growth in their jewelry business, the market hasn't liked it one bit. That stock has been under consistent pressure, and there's no sign of buyers, at least as of now. Aurobindo Pharma has been down. It's been moving, not from the, necessarily talking about the Nifty 50 pack, but in general, it's a stock that's been reacting to a pretty strong brokerage note, which has been cutting price targets on the stock, a negative brokerage note, and we'll get to that as well as we go on. There are names like Angel One on the lower side as well, which have been losing some ground. But all is not lost. I mean, for all the losers, you do have some green as well. Wari is having a good day. Names like Motherson Wiring, not too bad. CEAT, look at CEAT today, almost 6% up on CEAT as well. So some movers and shakers out there, but the Nifty guys finding it hard to break through this absolute logjam.
Well, that's right. But let's focus on PNGRB. They are set to release its final order on the unified gas pipeline tariff. The proposed unified tariff structure would replace zonal pricing with a single rate across the pipeline. My colleague Sapna got in touch with the PNGRB member, Mr. A.K. Tiwari, to learn more. Let's listen in to what he had to say.
I would like to say that in 2022, when we have announced the regulation, it was in the interest of the pipeline operator. And in 2023, when the unified tariff was announced, it was more focused on the interest of the consumers. But this tariff order, this amendment which we have announced recently, takes care of the pipeline operator, takes care of the consumer, takes care of the investor, as well as CGD companies. So earlier there were 3 zones, now we are going to reduce to the 2 zones, and with the concept of one nation, one grid and one tariff. And most important is that we are going to have one tariff for CNG customers as well as PNG domestic customers, because we have given huge target for CNG stations as well as the around 12 crores plus target for the PNG domestic consumers. So this tariff plays important role in the total cost. So when we are going to have one tariff for CNG and PNG, I think the CGD companies can take advantage of converting to achieving their minimum work program, and also CNG stations.
Okay.
So that is the concept behind it.
Okay. So we are at 2 zones right now. So if my understanding is correct, will you bring it down to 1 zone, something like that?
We have partly done here, because we have done 1 zone, 1 tariff for CNG, PNG, and slowly we are going to move for 1 tariff pan-India basis. This is slowly we are going to do it,
Correct.
But after analysis we'll do it.
Correct. So what happens to this 1 zone now? I mean, will that also remain, or you'll have a sectoral approach?
We may have, because CNG
Could you
and
please elaborate?
CNG and PNG are the customers to whom we have given the target, entities have given the target, and then minimum work program is there. Pan-India basis, we have
Correct.
allotted 300 plus geographical areas. So I think the CNG, PNG will be 1 tariff, and remaining maybe 1 tariff in the days to come.
How many years would this take? A year or 2 years down the line for this to work out?
We have concluded these tariff reforms within 2 years or so maybe 1 year.
Okay. And just a small repetition, what happens to the end user rates under the current tariff regulations, the fresh ones that you have brought out?
For CNG, PNG?
Yeah, what's the usually players?
They will reduce, because the tariff which is around 110-120 rupees per MMBTU on the transportation tariffs is going to be drastically reduced. As per the tariff order regulations, it is 52.5% of the second zone. If we resume the second zone as 110-120 rupees, it will be in the range of 50-55 or maybe that.
Okay.
So that is there.
Okay. So, net, what has been the response of the CD players themselves? I mean, good, positive, or not that happy?
They have participated in the open discussion. All were enthusiastic, and I have got phone calls with so many CGD players, and they are happy. And we are going to soon announce the tariff order. After due deliberations, that will do it.
How does it really benefit the CD players? I mean, does it bring down the input cost, but at the same time, the end user rates will also have to be reduced? So it's a bit of a balancing act for them.
Yeah, once the input cost, because as I have told you, the tariff is also one of the important input costs. So when the input cost will be less, the consumer will be benefited with the rate of the CNG and PNG.
Okay.
That is there.
And when do you plan to bring out the tariff order, sir? I mean, the tariff
there is a process. We have recently amended it. Now we are going to ask the details from the settlement committee as per the regulations. And there are some important pipeline operators are there, GAIL and Pipeline Infrastructure, PIL. So their tariff order, we have already concluded the PCD, public consultation, we have already concluded. So that is also on the card. So together we'll bring the tariff order of these.
Okay, it'll be synchronized.
Yeah, we want to synchronize, because again and again doing the tariff order and then is not.
Okay. So when can we expect the order for GAIL as well? Would it be like a month, 2 months, or could it be earlier?
I think
next month maybe?
Maximum 2 months.
Okay, okay. So they've also, made this recommendation of a 33% increase. So broadly, where do we stand on that as of now? Would it be somewhere as per what the company has actually sought, or would there be a more balancing act, a more nuanced approach that the regulator will take?
See, we always try to give the reasonable return to the pipeline operators, and we have analyzed, and whatever they have submitted, we are going to act on that, and maybe a balancing approach will be there. And I would like to say one thing, that system use gas is one of the important OPEX for them, for which we have already brought the regulation here, how to reduce the cost of system use gas, wherein we have given that they have to plan 75% of their estimated quantity which they are going to consume. They have to plan domestically or international market long-term basis for 3 years. They have to allocate whatever the least cost is there in their kitty for the system use gas, so that the cost will be reduced. So all these factors are being analyzed, and we are going to take a view on that, and we are going to conclude the tariff order very soon.
All right. Well, we'll keep an eye out on those stocks. IGL, I think, has perked up a little bit. Among all the stocks, I think that's moved to the high point of the day. But I will get Sonal to explain this in greater detail with regard to market ramifications as well. So we'll keep an eye out on that front. For the time being, let's go across to Mitesh. Mitesh, we spoke earlier this morning. And the markets have not moved. What's your take? Markets going through a bit of consolidation, but what's the trade right now if you take one?
So, good afternoon, Nigel. I have, been maintaining that the contraction phase is going on, and therefore not much might happen in the market. And I think that's what is happening. As I said, the only worry will happen in case the Nifty starts or shows signals of getting below 25,200, which we are still far away from. So nothing much practically on the index. But on the stock, I have a buy on SRF with the stop at about 32.40 for targets of 3,400. That's looking well. And Kotak Bank is something, which has kind of given a breakout in the last few hours. So Kotak Bank is a buy. You must stop below 21.95, look for targets of 22.85.
Okay. All right, got it. Thank you, Mitesh, very much for that. Now let's get to that exclusive story that we were referring to just a while back. And this could be potentially quite a big move. Sources are telling CNBC-TV18 that SEBI could consider linking options leverage to cash market positions. Yash is getting us these exclusive details. Yash, what exactly are you picking up? What kind of perhaps further tightening are we expecting in the F&O market?
Well, this seems to be a fallout largely of SEBI's investigation and action against Jane Street. What we've been given to understand from our sources is that market regulator may consider linking options market leverage to cash market positions. To simply explain this, SEBI is considering a proposal where only if you have certain amount of exposure in the underlying cash market, equivalent to that, like a multiple of that, could be the allowance as far as the options market exposure is concerned. Options market could be linked to the equivalent cash market through a derived formula. As I said, a formula will be put in terms of the cash market exposure, and a multiple of that could be allowed as far as the options market exposure is concerned. According to our sources, four things are what SEBI plans to achieve through this particular mechanism. One, increasing cash market liquidity. Second, reducing options market liquidity. Third, reducing excessive speculation and protecting retail investors. And fourth one, cut down on the ability of institutions like Jane Street to manipulate indices and make fast money. SEBI is also considering various other steps to sort of identify and plug any more loopholes as far as the options market is concerned. All these proposals could be discussed by SEBI's board very, very soon. Apart from that, to increase cash market liquidity, SEBI is considering a couple of steps like, allowing shorting in the cash market, also enhancing the SLBM or the loan against shares mechanism.
Thank you very much for that. And you can see all the capital market stocks take a beating today on your screen. Right on the ticker, you can see CDSL, for instance, is down nearly 1.5%. But even the others, like an Angel One, Nuvama, BSC, are all taking a big knock. Yash joining in with the CNBC-TV18 exclusive. Thank you for that. Gurmeet is now joining in from Complete Circle. Gurmeet, more tightening of the regulations linked to derivatives. What have you made of this latest news piece?
I think something will come. I don't think so. It may not be as strong as linking it to cash positions, but I think it will be more in terms of more awareness being created. Look at the losses, Rima. Last year was 75,000 crores. This year is 1.05 lakh crores. So in 2 years, the retail traders have lost 1.8 lakh crores. Now, this number could be disputed because a lot of people would have lost an FNO and Quadbi could have made money on cash because, you get the figures on a net basis, right, on FNO. But there are a lot of prop desks who also you do covered calls and they run a proper model. So, but even if you discount 20-30%, it's still quite a large number. And this can have issues in terms of, economic stability, if I were to say that. And I would not mind saying that some of the slowdown in urban consumption could partly be attributed to this. So from a long-term market stability point of view, I think some regulation and more awareness, you can't dictate behavior, but more awareness like the MF's, mutual fund Sahi Hai campaign. If you can do more campaigns on long-term investing and the risk management, especially on the FNO side, that would help. So I think from a market perspective, the shift may go from transaction-oriented capital plays to fee and annuity-oriented capital marketplace. Let's say, for example, asset management business. Look at, for example, HDFC, about 9 lakh crores of AUM. Their average spread is about 46-47 bips. So it doesn't get really impacted by too much activities, which means you will make 2,500-3,000 crore PAT, and it keeps growing. Now with alternates picking up, SEBI launching a new category like special investment fund, which is a 10 lakh category, I think that could be a game changer and might add more assets on the alternate side. And valuations are 30-35 times. I'm not saying that's cheap, but it's still lesser than, kind of valuations we are playing at 60-80 times to exchanges and depositories. So my sense is asset management companies may see more flows from an institutional flow perspective and from a retail participation perspective.
Okay, all right. Hi, Gurmeet. Good afternoon. Good to see you in. What do you make of the recent PNGRB regulations? And, what do you like from this space?
So, Nigel, while the valuations are very cheap, look at MGL, for example, 13-14 times trailing. But if you see last 2-3 years revenue, it's been very flat, 7,000 crores, give and take, 100 crores here and there. And last few years or few quarters, because of the cut in APM, which is administrative price mechanism, you had to procure gas on spot prices, which led to increase in your overall input cost. I think with the uniform tariff coming it might be good news from a consumer point of view, but I would like to see a little more clarity on pricing point of view, because anywhere where the pricing is not in your hands can have implications on your P multiple. One stock we are tracking more from a tactical point of view is Gujarat Gas. The volumes have recovered, especially the industrial gas volumes have recovered big time post-COVID. They have been spreading more CNG stations. Even the domestic consumption connections are improving. So that's something which is on our radar. But this is not something we would like to add on a fundamental basis in the core portfolio.
Okay, so that's a take on gas stocks. Got it. Midcap index, by the way, is down about 0.5% right now, and the advanced decline ratio has also progressively gotten worse. It's about 1,600 stocks now declining, and just about 1,000, just about 1,100 actually, which are on the advancing side. So that's been the picture. Gurmeet, hi, good afternoon. Okay, let's talk about the 6% cut on Titan. Now, is this a buying opportunity? Because we all remember the heydays of Titan, right? When the stock would just not let you get in. So is this a buying opportunity for maybe a great company, or is it time to look at other players, tier 2 players, which are growing faster?
I think you probably could wait for a quarter visit, whether it's a temporary slowdown because of the increase in gold prices. And also, one thing which concerned me, that the mix changed from studded and jewelry more towards coin, and that had an impact on margin as well. I know stocks like Titan, there is very little margin of safety. And still the heavy lifting is still done by the jewelry business. The other businesses, which is eye care, digital, the clothing, etc., are yet to meaningfully contribute to the bottom line. So I would be wait and watch. Even for other jewelry makers, I think you can have a lean Q2 and then a better festive season. So I think a better time would be maybe a couple of months later. I'm more keen on some gold-based NBFCs now, because that reduces your credit cost, delinquencies, like gold prices remain firm. and RBI is cutting rates. The norms with respect to lending, especially they became very stringent even on gold lending. That has eased considerably. And as volumes pick up and the credit cost comes down, interest rate gets transmitted, that could be a better play.
Gurmeet, what about Schloss Bangalore or Hotel Leela? I know you've looked and liked in the past Indian hotels, but what about Schloss Bangalore? There were no fireworks on listing. In fact, the issue price was 430. We saw the stock even, decline moderately over the next couple of days. But now brokerages are betting. Target price by BofA is 520, Morgan Stanley 549. They like the fact that the company's debt is coming down and valuations are seemingly attractive. Have you looked at this Hotel Leela? I know you've stayed there, but what about from an investment point of view?
No, I think we're happy with Indian hotels. I think it's been a good wealth creator for us. We also like Lemon Tree, more at the mid-end segment, and the model is changed now. If the managed key and own keys, the ratio would be more 50-50. So we stick with these two. And we are adding Interglobe as well on the travel side. We're looking at some more B2B plays also like RateGain, etc. So overall, we like the travel and tourism space. But in hotels, I think the largest allocation remains Indian hotels, will continue to remain for some time.
Got that. Thank you very much for joining in. As we get into a break, let's get our viewers some excerpts from our conversation with our market editor for the day, Motilal Oswal's Ramdev Agarwal, who gave his take on the stake selling spree that we've seen from promoters, private equity and venture capital firms in India. Should you be worried, or is it just testing the market depth and it's good for Indian investors over the longer term? Listen into his views.
More customers, more stocks to trade, and of course the tailwind of economy, which is sustained at 7%. So I think it's a complete Goldilocks kind of situation, because in the stock market, any kind of melt up is borrowing from the return of the future, which creates problem. Now it will be very good for the market and for the market sustain expansion. A lot of new companies are going to come, and I think you have seen every week there must be some record. I think Prithvi Prime Database can throw what kind of a trend they are seeing. This is a revolution in terms of number of companies which are getting listed. So one, they are going to get in the IPO itself, which is much more going to be primary selling, some amount of secondary selling. Second, once they discover the price, then this promoter's stake. But then they can monetize, and they are free to either invest for the new ventures or consumption or philanthropy.
Welcome back. You're with us on Closing Bell, and joining us next is Tushar Pradhan, Director of Hexagon Partners. Tushar, thank you so much for joining in. First and foremost, we'll talk about, of course, investments and portfolios, etc., in just a bit. But what have you made of the market's mood and character last couple of days? I mean, it's after a very decent comeback from the lows through much of April, May, half of June. Suddenly, the market's getting into this limbo mode, a bit of a logjam of sorts, extremely quiet. What do you make of it?
Well, I think on the surface, just like in the sea, maybe it looks a little calm. But there are many stocks which have seen significant movements underneath. So individually, stocks have either gone up substantially over this last week or they have come down substantially. So there is, on an average, maybe a calm that we can see from the visible, average. But I think there is some action otherwise. But I think the main reason for maybe a hesitancy or maybe a lack of direction could be because of this overhang of the trade negotiations which are happening. And one of the things which I have been highlighting for some time is that it's not about the trade negotiations per se, but how will the global supply chains actually change in response to finally when people come to know what the tariff rates are going to be across the world, which as of now, which we don't know. And they keep getting postponed. So July 9 was supposedly the first deadline, and now it is going to be shifted a little further. So the level of uncertainty continues to remain very high. And as you all know, markets don't like uncertainty. So it's one of those things which probably could be an answer to your question in terms of why the markets have just kind of become subdued a little bit, because now the wait is a little longer. I think that's one of the reasons which I can come up.
What about the Jane Street impact on the markets? They were the market maker for many trades, especially on the derivative side. On the other side of the trade, they were always there with the kind of volumes and liquidity they provided. And now that just seems to be absent. Is that a big factor? And how will it impact the markets going forward? What are the implications of SEBI's interim order?
See, these are issues which, at least at my end, I don't have much data in terms of knowing what is their participation. And if that is one participant, there may be so many other participants which we clearly don't have any data on. We all know that markets are, a function of demand and supply, in addition to the fundamentals that we look at over the longer term. So in the interim, if there is a change in terms of activity or by way of participation by these very large participants, or as we call it, the big whale traders, then it is going to have an impact. However, as I said, we don't have enough information to decide whether this is going to have an impact on other big traders or the fact that the volumes are going to go in one direction. I think overall, if you concentrate on the fundamentals of an economy, the traders are going to be at a second derivative of your base economy and your base market, right? And they will keep changing from time to time. So I won't read too much in terms of what's going to happen immediately. I think focusing on the long term is something that we continue to do, and I don't think there's any change in that picture.
All right. Hi, Tushar. Good afternoon and good to see you, Ben. What about the consumption theme? Some of those stocks have given you zero returns in the last 5 years. But now suddenly the street is getting a little bit optimistic. And mind you, the bluest of blue chip names have not given you returns, while the markets have compounded by more than 15-18% on an annual basis. It's time to look at them. Indians are going to have more amount of money in their hands. Input costs are hopefully going to cool off. And the hope is that, consumption will go up. Your take?
Yeah, that's an interesting question, Nigel. I think when you look at an economic cycle, you have to remember that, there are certain kind of companies which take center stage, and then they hand the baton over to another set of companies, and then another over the entire cycle. So it starts with, a capital cycle. It starts with a capex boom, where there is a significant increase in production facilities, and essentially manufacturing as a base across, either driven by demand or the fact that there is credit available, and that leads to a capex cycle. Now that is followed by significant increase in employment across the economy as a direct result of this increased investment And then that leads to increased incomes. And of course, India being an agrarian economy as well, there's a combination of rural and urban, which adds to the general demand going forward. And once you have this cycle of increasing incomes leading to consumption, we have a lot of pent-up demand, which first of all comes in what we call as discretionary, which is more to do with items which are more sustainable, like a capital asset or a appliance for most people. And then that is followed up with what we know as FMCG across the economy. So there are certain phases that these companies do well. And as we all know, FMCG largely is a defensive sector where we see a level of consumption no matter where the economy is. So we've seen our economy at a very significantly high rate of growth in the last 3 or 4 years, where consumption really comes as a significantly smaller portion of the growth in the overall economy. And as a result, obviously, the stocks haven't done much. I think if we continue to remain optimistic about our economy and the growth going forward, consumption, I think, is going to remain fairly small as a percentage of the overall growth, given the fact that most of these companies already trade at significantly high PEs. So I fail to see whether you're going to see a FMCG-led boom or that these companies will start making significantly positive returns from here.
Okay. So that's on FMCG. And finally, Tushar, I mean, before we let you go, just overall, given everything that's happening, we're running into earnings season. Just in terms of the total portfolio construct, right now, what would be your top 2-3 themes?
So I think we continue to remain very, very positively inclined towards capital goods. Essentially, I would think mainline manufacturing going forward, including process industries. We've seen a little bit of a lull in the last year, even the financial year ending FY25, where we saw a little bit of a tapering off in terms of ordering, whether it was from the government capex side or the private capex side. Interest rates were also significantly higher than what most expectations were. So there was a little bit of a bottleneck in terms of incremental capital addition. I think the current moves and the preemption from the RBI in terms of CRR cut, along with an expectation of gently falling interest rates into the future, I think manufacturing and essentially capex-driven capital goods is where most of our expectations are very, very keenly at. This is, of course, followed by the fact that we are going to see significant infrastructure growth, which is a continuing feature, which again had a little bit of a lull last year due to election activity and generally reduction in activity overall. I think all of that will lead to even auto to a certain extent doing well domestically. Now, this may not tally with trends globally, but I think our economy is pretty much on its own steam. So I think a little bit of auto, discretionary, capital goods, infrastructure, this is really where our keenly focused sector bets are likely to be. I think secondarily also we do tend to like the capital goods down in the machinery side. So we are talking about capital goods which are in the power transmission, that capital cycle as well. And I think that is really, again, something which is likely to pick up. Again, where we saw a little bit of a lull, both from a stock price perspective as well as volumes perspective.
Tushar, always good to hear your thoughts. Thanks a lot for joining in and giving us those details. Wishing you a good day, good week ahead as well. We catch up soon. Well, time to slip in a short break. As we do that, let's get you some market opinion, actually. Earlier today, we spoke to Gautam Dugat, the head of institutional equity research at Motilal Oswal Financial Services, to understand his outlook on the market and stocks and sectors he's bullish on. Let's listen in to what he had to say.
We remain very, very positive and constructive on jewelry. Titan has been our long-standing top idea in not just jewelry, but overall consumer discretionary space. And our view has not changed. Coming to trend, that is where we've had a tactical positioning change in our model portfolio now. We've replaced trend with Jubilant FoodWorks. For a company which is trading at 110, 120 P, there's absolutely no room for error. So there are quite a few additions there. Jindal Stainless is something we've added. UTI AMC is a new stock. As I mentioned, Radico, Jubilant, they are new additions. We've added Ludha, Macrotech basically. We've added Niva Bupa. So quite a few allocations, new allocations. And of course, we've also gone, we upgraded our stance on auto.
Welcome back. Well, the market's not moved too much, in fact, but in the last few minutes, suddenly we've seen a bit of a spike that's come in there on the Nifty itself. And that's courtesy of a few stocks that have now bucked the trend. Wipro has moved a little bit higher. Mahindra & Mahindra, in fact, has cut its losses. So we are back at around 25,500 odd. JSW Steel from the red, that's moved into the green. And let's pull up a heavier name. I think ITC has done a little bit of a jig on its own. ITC, you have SBI. Both these two are larger weights on the index, and both of them have seen a bit of an up move. The Nifty Bank, by the way, is now up 300 points, and that's led the way. Mitesh Thakkar is back with us. Mitesh, still in a range, you would say? Or do you think this market actually wants to go ahead and test higher levels? And also give us your stock picks.
The signs of expansion haven't appeared while the market has moved 40 points higher from the negative side. But again, I think, what could be the key here would be the Bank Nifty. We had a buy on Kotak Bank, and I think, that's done well today. SBI is also looking good to me. So maybe if the Bank Nifty picks up, we'll get some signal on the upside on both the indices. But for the timing, just waiting and watching it out. SBI, in fact, is one of the BTST calls. Take a BTST here with a stop at about 807 for targets of around 820. And the other one is a BTST on NHPC. I think that's, fired up in the last 1.5 hours. So BTST here at the stop at about 87 for targets of around 89.5.
Got it. Okay. All right. Thanks a lot for that, Mitesh. Let's focus on one of the top gainers on the Nifty, though. And all through the trading session, Kotak Mahindra Bank is doing well. That's after it reported a strong showing in its quarterly update. Gaurav joins us to fill us in with more details. Gaurav?
Well, yes, Kotak Mahindra Bank definitely remain as an outlier today, and the reason being that a strong update is what we have seen from the company for first quarter. When it comes to loan book, we have seen 14% growth on a year-on-year basis, and this also translates into 4% growth on a sequential basis. Now, this is actually stronger than the industry growth, and it is also stronger than what the consensus was expecting from Kotak Mahindra Bank in this quarter. On the deposits fronts also, we saw a strong set of number, 14.5% of growth on a year-on-year basis is what we are seeing from the bank. Although this growth was driven by the term deposits because CASA growth was a little softer on a year-on-year basis. But let's not forget that Q1 is usually softer for CASA, and that is the reason that is not a big concern. Now, what remains as a key thing to watch out for is the loan book proposition. What segments have actually led this growth is something which is really important to see in terms of net interest margins, but that is not a concern as of, at least for now. This will be seen in its Q1 results. For now, on the back of the good set of numbers, we are seeing the stock is still holding up in trade today.
Thank you very much for that. Let's now get to D Street chatter. Things are very, very quiet on the index front. But let's find out what's happening in the dealing rooms. Nimesh is now joining in with what he's picked up. Nimesh?
Hi, Rimano. So, as you rightly pointed out, another lackluster day of trade, not much in terms of volumes as well. But there is individual brilliance in some stocks and some sectors. And again, you know, the PSU is the one which is leading the way. Some select PSUs are again buzzing in trade today. And there is generally momentum towards the PSU stocks, even from a flow perspective. I guess from an FIB or institutional flow perspective, today the sector which stands out is defense, as well as a bit of select financials, and that's showing up in the Nifty Bank as well. But again, it's very, very selective is what I understand from a flow into select private bank stocks, as well as in some defense names as well. I guess the big trade or the near-term trigger would be the India-US trade deal, and that may have an impact on some sectors like textiles, pharma. So those are the things to watch out for, at least in the very near term. But again, you know, some individual stocks are doing good, some sectors are doing good, but otherwise it's been a lackluster day of trade. Even from a flow perspective, it's quite muted.
All right, but some buzz on D Street chatter. Nimesh, tell us individual stock. What's the buzz?
Well, so the first stock on my list is Aditya Birla Capital. It's been consolidating in a narrow range, but I understand there could be a large block very soon. Remember, this is the trading window is closed for the promoters. So if the deal has to happen, it has to be non-promoters. I understand the PE is likely to sell some small stake in AB Capital very soon. So that's the first name. The second stock is India Shelter. It's recovered from the day's low after a large block, nearly 5% equity got changed hands. I understand the PE, the venture fund was a seller in today's block. So the disclosures will be quite interesting on who the seller and buyers were. The third stock is IDFC First Bank. It comes on my charter list every now and then. There is buying interest from large institutions in IDFC First Bank ever since the bank raised money from some market investors, and even in today's trade there will be buying. So expect high delivery volumes in IDFC First Bank. And the last is Torrent Power. Generally a stock which doesn't get too much from an institutional perspective, but there is selling pressure is what I understand in Torrent Power in today's market.
Thank you very much for that. Quite a few hotel stocks are higher in trade. So ITC Hotels, 2.5% up on that. Lemon Tree has gained close to about 5.5%, 6%. Perhaps it's a rub-off impact of the up move seen on Leela Hotels. Schloss Bangalore, BofA and Morgan Stanley have issued coverage in the stock. Target price stands in excess of 500 rupees. Stock is spiking. Mangalam joins in.
Right, so we have both the investment bankers to the IPO, which is BofA Securities and Morgan Stanley, among the many others. Now they've initiated coverage on this stock, so they are looking at it from that angle and saying that there is still a lot of up room left in Schloss Bangalore, which is basically the operator of Leela. BofA Sec, for instance, has a buy rating and a target price of 520 rupees. They believe that the revenues of the company can compound at around 12%, EBITDA at 14%. Overall valuation is fairly attractive at 20 times FY27 EV to EBITDA. But more importantly, they believe that the net profit on a low base can compound over 90% for the next 3 years, and that's where the delta will come in. Morgan Stanley, on its part, has a slightly higher target price than BofA Securities at around 549 rupees. They have an overweight rating as well. The only risk that they're putting on the table is that of the table turning for the hotel industry, and more importantly for Leela itself. A large part of their revenue comes in from a small number of hotels, so that concentration risk is something they've put on the table. But be that as it may, they too believe that the EBITDA of the company can grow upwards of 12%, and the net profit on a very low base and on account of lower finance costs can surge almost 9 times in the next few years. And with a stronger balance sheet and higher free cash flow, they will be well capitalized to fund the next cycle of capex as well. So both these brokerages fairly confident on Leela's prospects.
All right, checking in, looks like Mangalam, but you're buying a lot of shoes. What about jewelry, Mangalam? The ladies want you to buy more. You're not doing your bit. Titans in focus. Disappointing soft quarter-one showing.
No jewelry, no shoes, Nigel. Nothing. No buying anything right now.
Good. I told you. Time will catch up.
Yes, and for Titan, the important part is that you got to look at it in two ways. 18%, one would say, okay, not bad on Titan's base, etc. But two things happened. You know, a couple of weeks ago, Morgan Stanley put out a note, or rather Macquarie put out a note saying that they're expecting 20 to 21%. Their channel checks have suggested a very strong first quarter. And the second part is that Titan's numbers came in after Kalyan and Senco. Senco reported a 24-25% retail growth. Kalyan itself reported a 31% growth. So to that extent, Titan looked a lot weaker. Companies, attributed this weakness to gold volatility that's affected consumer sentiment. And add to that, studded ratio was lower. Because of higher gold prices, people are opting more for plain gold jewelry than studded jewelry, and that's margin dilutive for the company at large. Studded ratio has been under pressure for the last few quarters for Titan as well. More importantly, buyer growth was flat year on year. Now, a large part of the weakness can be attributed to the fact that, Titan has higher exposure to Maharashtra than, say, someone like a Kalyan or a Senco. And this time around, we had Gudi Padwa in the previous quarter as against the first quarter in the last year. So that base effect and regional skew may have come by, but the street expectations are such that it's seeming like a disappointment. And then we're also seeing some other, portions of the company which are doing well, but they're ancillary. So watches, for instance, grew 23%. We saw a near 50% jump in their fragrances and bags business that's reflected in their overall emerging business. And Carrot Lane grew by about 38% as well. So ancillary is doing well for them. The large part of the business, which is jewelry, not as well, with flattish buyer growth.
All right, Mangalam, talking about quarterly updates, one segment where there has been a decent showing from smaller players is the pipe makers. And earlier today, we had highlighted, Hari Om Pipes, a stock that's got absolutely hammered. That has spiked up. I think we should get the intraday chart up for our viewers on the screen. From the top, it's seen some selling. But a stock after halving from the top, well, that's popped up in trade because they delivered a 30% volume growth. As is the case with another smaller name like JTL. Now, that stock, in fact, it's got hammered from the top. Profitability took a hit. Volume growth has been disappointing. But in quarter one, JTL, the volume growth out there is 25%. Keep in mind, the leader is APL Apollo. That's delivered only a 10% growth. So that's why you see some kind of interest in stocks like JTL, Hari Om Pipes. The last couple of trading sessions, they are moving with very, very high volumes. So that's important. Also, we had a recent listing, which is some of the steel tubes. That one as well has moved up. So on a relative basis, a couple of these smaller names are actually looking more attractive in comparison to the large names. So that's why, in fact, Sadbhav Steel Tubes, I think we should get that stock as well up for you on the screen. That said, let's focus on brokerage notes. Bellrise, that's in focus after Jefferies note. Sudarshan joins us to help us out with the fine print. Sud?
So what a move the stock is seeing. It's up currently at 10% after Jefferies has initiated coverage in the stock with a buy call, and target has given is of rupees 135 per share. And that implies an upside of almost 30% from current levels. Jefferies believes that company might see revenue CAGR of 12% and EPS CAGR of 18% over FY25 to 28. Even it believes that balance sheet might improve, and in FY25 that company has net debt of almost rupees 600 crore, and against this it might have net cash of rupees 2800. Sorry, it had net debt of rupees 2800 crore in FY25, and by FY28 end it might have net cash of rupees 600 crore. Also on the valuation front, it finds attractive at 18x FY26 P, and it believes that it might improve further if company simplifies its structure. What are some of the catalysts? It believes that rising two-wheeler demand and focus on premiumization will aid the growth. Also, company has been increasing content per vehicle and also focusing on the expansion into four-wheeler space and the export segment. That also might aid growth. And on the back of all these factors, Jefferies is bullish on the stock.
Got it. All right. Thanks a lot, Sud, for joining in and filling us in with those details. Let's welcome Jay Bala of CashTheKiosk.com. Jay, a bit of a lull. I think we haven't moved too much since the last time we chatted. But your guess is we are bracing ourselves for a bigger inning, so to call it, in cricketing parlance. The Nifty is gradually going to find its form and rocket up from here.
That's right, Ajit. Good to be here. Yeah, probably the markets are heading higher is more. The reason being Reliance is having a breakout like I pointed out last time. The 1538 was the very short-term resistance. It's crossed that yesterday too. And it's like the only resistance for Reliance right now is about all-time high at 1600 and 1606 to 1632. So, that should give fillip to the overall market direction. And the resistance for Nifty is about 25,660. And once that's taken out, it's only 26,000 odds is the next resistance for the markets. So the odds are looking bright for Nifty. So Reliance is giving the heads up for the markets that it's possibly breaking out higher.
All right, Reliance, yeah, that's the one actually that was a relative underperformer a few months ago. And the last 6 months, Reliance Industries, that big boy, which is as good as an index itself, that's really been leading the way if you just pull up a last 6 month chart or thereabouts. Let's talk about the other big component, Jay, though, the Nifty Bank. What are the levels you're looking at the Nifty Bank? And give us your view on a couple of these banking names. Kotak Mahindra Bank, well, the quarterly update is very, very good. We'll have to keep an eye out on how the NIMs pan out because we know that they have a large amount of their loans that are linked to repo. So we'll have to see whether or not there is some compression because that will adjust first. So Nifty Bank, Kotak Mahindra Bank and SBI that's gone through a nice sleepy period. Is it ready to fire up?
Yeah, that's what it's looking like. I know SBI bottomed ahead of the overall markets in March, and the markets bottomed in April. So that's having a slightly different cycle versus the Nifty. So it's possibly leading the markets higher. But the structure is that it's a bit overlapping, not excessively or desk thumping bullish. But it is bullish if SBI were to take out 837. And if that happens, I think the overall markets are going to get further fillip besides Reliance. And when it comes to Kotak, at least a short-term high is coming, which could also be a fresh all-time high for the stock. So both these stocks are likely to lift the banking index. The resistance for the banking index is about 58,500 to 58,900. Sorry, 59,000. And the supports are about 53,480.
All right, we were talking about a couple of stocks earlier, Jay. Let's get to them. Hariom Pipes, we were talking about how the stock halved from 850 to around 400 rupees. And then it's bounced back post the strong operational update. I believe that's one of the stocks on your radar. Tell us why, because otherwise in the last 1 year, it's been a big underperformer. And also Lemon Tree, which is moving with very, very good momentum. But you believe they're both good for higher levels. Tell us more.
That's right. Let's take Lemon Tree first. It's bottomed in October and it's moved from the October lows to 2025 high in 5 steps. So that's a trending move for eliticians like us. And then from then on, it's gone into a sideways consolidation, which has been choppy and overlapping. That's once again a classic corrective signal. Today, the price crossing over 141, it's signaling a reversal for the October to 2025 January move. Or a continuation to that move. Basically, it's an inverse head and shoulders breakout, and the stock is likely to hit somewhere close to 170, maybe even 200. But we'll leave it as a conservative estimate about 170. When it comes to Hariom Pipes, it's a very interesting stock. It's a relatively new listing, listed in 2022. From the 2022 listing low, it's got to about 888 in 5 steps, and then it's pulled back to near perfect 61.8 Fibonacci retracement, and that was about 320. So from that point onwards, it's breaking out in today's price action. There's a great possibility that this is going to be a 3-bagger from here on. But be a bit careful. The price history is quite recent. It's 2022 to 2025. So I'm bullish on the stock. With the caveat that it's got a relatively less price history, but it's reasonably good price history to consider. It's going to fresh all-time highs.
Okay. All right. The market has made quite a move in the last 15 odd minutes. Very, very interesting. From being absolutely comatose, not even 1 or 2 points up or down, suddenly you've had this big swing on the Nifty. 60 points higher now. Very, very interesting. We'll do one thing. We'll take a break, come back and also get Jay's views on the whole Jane Street saga and whether the winding up of the positions there, whether it has any near-term implications for market volatility or volumes. We'll get to that in just a second. But as we take the break, remember to tune into the all-new CNBC-TV18 Prime, bringing you insights from policymakers, business leaders and economists. CNBC-TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. You can tune in at noon for the Global Reset, at 1 p.m. for the Big C, and the Global Lens comes to you at 8:30 p.m. Okay, let's get you a quick view on the global trade and tariff conundrum that's been on. William Lee from the Milken Institute spoke to us about what the implications of these Trump tariffs could be.
What President Trump was trying to do was say, bring your investments into the United States, bring your production into the United States, bring your technologies into the United States, and we will give you a protective barrier of tariffs to protect you from unfair competition from other countries. And right now, President Trump has sent out a bunch of letters saying, okay, you don't give me an offer, here's my offer to you, 25% tariffs. I think that surprised everyone by the fact that they were so low. But I think that's also President Trump's way of saying to everyone, let's talk, and let's talk now.
Okay, that was a global view coming in. Back to that conversation with Jay Bala. Jay, very quickly, before we move to other sectors and stock names, I just wanted to get your thoughts on the implications of this wind down from, a large entity like Jane Street and some of the other algo traders, high-frequency traders in the market. Do you see that impacting the market in any sense, whether on weekly option expiry days or monthly expiries? Should we be prepared for anything over the next few weeks?
Yeah, I see a very short-term impact on the options market. Possibly, in the very near term, the other algo firms will get a bit cautious, and there could be, and obviously some retail investors would also consider this as a rigged game, and then there'll be options drying up in the short term. But in the medium term, it should all come back to normalcy. And then the main problem is not with what Jane Street did, and it's basically do with the concentration of the Nifty banking index. There was too much weightage towards HDFC Bank, and if you take up what is a good index structuring, you would see no index should have more than 10-15% if you are structuring a good index, and the fact that they were optionable, that has caused the problems. But this, at my very short point, is that this is going to be a short-term impact.
Okay, all right. So short-term impact maybe, but not too sort of disruptive. So let's quickly get back to stocks and sectors. Give us 2-3 names that look perhaps like strong trades to you, because your overall stance on the market has been fairly positive, Jay.
Yeah, the markets have done good rotation from the April lows, and the markets are waiting for Nifty IT to join. And given that the results season for the tech-heavy Nifty IT index is quite just around the corner, that it looks like Nifty IT is consolidating and possibly a breakout is coming. But I've considered the move from the low from the April as a counter-trend bounce, and I've been anticipating somewhere about 39,000 to 40,000. The index is there. If 40,000 were to get taken out for the Nifty IT index, I think that will be a good breakout, possibly led by TCS, about 3550. Also, the real estate sector seems to have gone to a sideways consolidation, and it's starting to perk up one more time. So, this is another area where you might want to keep a watch. Probably further higher highs are likely to come through. And obviously, reliance on banks are the key to markets pushing much higher in terms of weight.
Okay, all right. Jay, I wanted to ask you about a couple of other names. The Troika is something that we track. The US bond yields, that's perked up a little bit. Where is that one headed from here on? And if you could also tell us about Brent crude prices, because the OPEC plus, there was a sharp spike in production, but Brent crude prices have been resilient. What's your view on both these two?
Yeah, when it comes to US 10-year yields, it's no joy for traders. It's stuck in a range between 410 bips and 466 bips. So a breakout on either of the side has to happen before a trending move happens. My guess is that it's possibly breaking down below 410, but at the moment you're sitting on the hands when it comes to the US 10-year yields and the bond markets. When it comes to Brent crude, I'm anticipating possibly end of a counter-trend bounce in the next couple of sessions. Maybe could stretch into beginning of next week. But I anticipate the April lows to get tested in the next couple of months, maybe a couple of months to a quarter. I think the final low is in place for the long-term corrective that started post the Ukraine war. So I'm anticipating a bump up to about $71, $72 for Brent, and then a decline below the April low. For the NYMEX variety, the low April low is about $55. So I'm anticipating a break of the April low in the next quarter.
Okay. All right, Jay, thanks very much for all the analysis and the updates today and the trading ideas. We'll quickly wrap up the day, which has had some interesting action towards the end of the last half hour. Maybe you can attribute that to the weekly expiry on the Sensex. But 60 points up on the Nifty is what we have. I think there are interesting statements from Ms. Madhvi Puri Butch on the Jane Street matter, which are at the bottom of your screen. So we'll get to that in a second. But overall, for the market, the Nifty finally managing a little bit of green. The leaders include names like Kotak Mahindra Bank, Eternal, which is up 2%, Asian Paints 2% higher, NTPC and BEL from the PSU space did well today. There's Grasim, Adani Ports, and some big names like